I want to just share this one gem, if I can be so bold as to call it a gem. It's just something that's really worked for me, and I like to share these thoughts with you guys, anybody who's working with momentum indicators. It's really not about crosses. A lot of people look at an indicator, particularly if you're new to this, and you're going to say, oh, well, the stochastic crossed from positive to negative, or the fast stochastic crossed above the slow, so there's a buy signal. And I caution you from that, okay? Read and react. That's what we're doing. These three technical indicators are what we use at the core to tell us when a swing trade has started. So these are probability algorithms. Doesn't guarantee we're going to make money. Our job as investors is to put capital to work when reward is worth the risk and the probabilities are in our favor. If we do that over and over again, if we keep executing that way, we're going to come out ahead, right? Step one is to protect capital. Step two is to capture upside when the window's open. So now we've been protecting capital all year at the ARMOR Report, and we use the risk monitor for that guide, right? It's 7 index algorithms. When they all communicate the same thing on a bullish point of view, that ends up being our risk on entry point where we have a high probability of success. The markets are going up, and that's when we put capital to work. When we can't get confluence, we hold maximum cash positions, and that's the position we've been in for most of the year, which is why ARMOR Report insiders, myself included, and everybody who works with us, we're outperforming the markets in a significant way because we've carried cash for most of the year and large amounts of it. But the next step is, how do we capture the upside? And so there's a moment between cash and risk monitor green where there's a swing trade that we're going to try to capture. And this is how we're going to do it. I'm going to walk you through right now. Ready? Here we go. This is a 60-minute chart. So you grab a pen and a piece of paper, and I'm going to walk you through some basics of the chart you're looking at. Okay, so for swing trading purposes, we use 60-minute charts. You're looking at the S&P. Every bar is 60 minutes. The blue bars are up. The red bars are down. The green line is the 200-day moving average. The black line is the 50-day moving average. Then we use the 14, the 25, and the 20. These are all part of the ARMOR algo. But down here, this block down here, you're going to see 4 indicators. These are momentum indicators. So now let's be clear about something. First of all, a momentum indicator is not a guarantee anything's going up. It indicates that there could be a rally. That's it. Okay? So this is one piece to the puzzle. It improves probability when you're putting money to work to know where the momentum indicators are in any type of cycle. So these are the 3 we use: stochastics, directional movement index, and the commodity channel index. Stochastics, DMI, CCI. Those are the 3 top indicators. Now, like I've said many times, thousands of lines of code, more indicators. There's more that goes into the ARMOR algorithms. But I just wanted to share with you these 3 essentials, because if you're embarking on this endeavor of building some type of probability algorithm, and by the way, I use TradeStation. I've been using TradeStation literally for 30 years. There are probably other programs out there, maybe better than TradeStation. It doesn't make a difference what you use. I'm just used to this for a long time. I write in easy language, so all the algorithms are written in easy language, but we can port them over to anything. But for the sake of this conversation, it's TradeStation. Okay? And you simply go up here to the top of your chart. Okay, and what you'll find at the top of your chart, or you can just click on it right here, are all your indicators. Different strategies, right? So you add a strategy. I'm not going to walk you through how to use TradeStation, but you add a strategy and it comes up with something that looks like this. And there's just hundreds of strategies. Okay. I'm not going to get into the weeds on that. But these three, and we use stochastics twice. We use a fast stochastic and a slower stochastic. We're looking for confluence. Use whatever indicators work for you. These three work for me. And I'm going to talk about the commodity channel index the most because I think it's a unique index most people don't use. I find it's best to try to find indicators that are not overly used by everyone. Because if you think about these types of things, they're probability algorithms. And even when you find a vein that works for you, even when you're mining a vein of gold of trading, okay? The nature of markets is to collapse that vein of gold and mine it out. So if you were to find this one unbelievable indicator that's making you all this money, I guarantee the window will close on you because everybody else is going to find it too. So the key here is not to fall in love with an indicator, not to think there's one indicator that answers everything. There's not. There's many different things that go into trading successfully. Confluence is the most important thing on my desk. We use 7 different algorithms for the risk monitor. They're all calibrated to the volatility of each index. That's the next thing I'd like to share with you when it comes to even these 3 indicators. We take them and apply volatility of each asset to optimize the effectiveness of the indicator. And this is something I think most people overlook. So a lot of people will say to you, oh, use the MACD, right? Everyone loves the moving average, convergence, divergence. I used to love it too. I used to use it all the time until like everybody uses it. And to me, it just loses value. That's my opinion. Okay. You could argue the same thing about stochastics, but what we try to do, depending on the top day and multi-day volatility of the asset, just think about it logically. Using a 14-day stochastic on the S&P and then applying that same stochastic, that same 14 days to VIX would make absolutely no sense. The volatility of VIX is completely different than the behavior of the S&P. So what you want to do is try to optimize your indicators for the asset you're working with. Don't be lazy and try to apply it to everything. A small cap stock is going to have a different volatility complex than the S&P 500. This is why when we say at the ARMOR Report we have stop losses, we don't use a static stop loss like 7%. You buy it, it goes down 7%, you sell it. That makes absolutely no sense to us. I don't know how anybody could argue that makes sense, right? Because if you're trading a low beta stock that has a volatility of X, and then you're trading a high beta stock with a volatility of 2X, how does a 7% stop loss make any sense in those two scenarios? You might want a 3% stop on the lower volatility stock and a 10% stop on a higher volatility stock, right? It just makes common sense. So think these things through when you're applying any indicator. I want to just share this one gem, if I can be so bold as to call it a gem. It's just something that's really worked for me, and I like to share these thoughts with you guys, anybody who's working with momentum indicators. It's really not about crosses. A lot of people look at an indicator, particularly if you're new to this, and you're going to say, oh, well, the stochastic crossed from positive to negative, or the fast stochastic crossed above the slow, so there's a buy signal. And I caution you from that, okay? Anything that everybody can see generally loses value. So what you're really looking for are divergences. You don't just look for a cross. What you look for is the market to go lower And yet you see higher lows in whatever your momentum indicator is. Okay? Or what I like to call a double clutch. I like to see, for instance, on the stochastic, break down the market, stochastic makes a positive signal. Okay, I don't care about that first swing. It goes back down with the market. Market goes to new lows, but it makes higher lows, and then it crosses positive again over a longer period of time. So now you've got a positive divergence. Positive divergences with crossovers works better than crossovers by themselves. And then here's the last piece. Pay close attention to where the crossovers are occurring, particularly when it comes to the commodity channel index. And this was a real eye-opener for us as we were writing our algorithm. The CCI is a unique indicator, and I don't think a lot of equity players use it. They think it's called a commodity channel index. So I'm not trading commodities or whatever. I don't know. But the CCI works on all kinds of assets. And what I found really unique about it is that there are ranges where it becomes very effective. And in between those ranges, it's not effective at all. That's really interesting. So how oversold or how overbought, married together with the quote positive or negative crosses, really improves the potency of the momentum indicator. The three top indicators we use to drive the bus: commodity channel index, DMI, directional movement index, stochastics, those three. And we calibrate them for the volatility of each asset, which I think is overlooked by a lot of certainly new algo writers. Okay, so make sure you infuse volatility into what you're doing. Okay, and then look for where you are in the range of overbought and oversold. It really affects the potency of the momentum indicator.